In 2009, a single consumer product distorted the trade balance between the world's two largest economies by billions of dollars, triggering political outrage based on a fundamental accounting error. At the time, every iPhone shipped from Shanghai to Los Angeles was recorded as a $500 export from China to the United States, fueling the narrative of a terrifying manufacturing deficit. But when the Asian Development Bank dismantled the unit economics of that device, they found a discrepancy that revealed the true structure of the global economy. This data point exposes the difference between gross trade, which dominates the headlines, and value-added trade, which dictates national wealth. A distinction we dissect frequently here on Finance Saga to cut through the macro noise. The label, Made in China, was never a statement of ownership. For 30 years, it was a receipt for low-value assembly services rendered to the industrial powers of the West. However, if you track the internal component sourcing of that same device just 9 years later, the value captured by Chinese firms had surged from that 3.60 baseline to over 1040 per unit, a percentage increase that signals a rupture in the old global order. The narrative that China is merely the world's sweatshop is a decade out of date. The reality is that the sweatshop bought the laboratory. To understand how a nation climbs from assembling plastic toys to dominating high-precision supply chains, we have to look past the factory floor and into the financial plumbing that makes it possible. We can visualize this process through a specific mechanism map that will guide our analysis today. Imagine a flowchart with 3 distinct boxes moving from left to right. The first box is the funding source, labeled suppressed household income. The second box is the intermediary, labeled state-directed banking. The third box is the macro outcome, labeled industrial capital deepening. Most Western observers assume that China's rise was fueled by cheap labor, but labor is merely the entry ticket. The engine of the ascent is in that first box, financial repression. By keeping household wages growing slower than productivity and capping deposit rates, the system effectively taxes the saver to subsidize the borrower. This forces a massive pool of cheap capital into the second box, the state-controlled banking sector, which does not allocate credit based on short-term profitability, but on strategic industrial goals. This capital is then funneled into the third box, funding the machinery, robotics, and R&D needed to move up the value chain. This mechanism turns household austerity into industrial dominance, allowing factories to operate with longer time horizons than their Western competitors who answer to quarterly earnings calls. This is not a uniquely Chinese phenomenon. It is the standard playbook for late-developing industrial powers, and we have seen this exact movie play out twice before in modern history. To see where this trend lines up, we need to look at Case A, Germany, in the late 19th century. In 1887, the British government passed the Merchandise Marks Act, forcing foreign manufacturers to label their goods with their country of origin. The intent was protectionist. British legislators believed that forcing German companies to stamp "Made in Germany" on their products would act as a warning label to British consumers, signaling inferior quality and cheap imitation. At the time, German industry was indeed copying British designs and undercutting them with lower labor costs. However, the signal misfired. The "Made in Germany" stamp, intended as a mark of shame, forced German manufacturers to compete on quality rather than deception. Behind the scenes, the German banking system, specifically the Hausbank model, was engaging in the same mechanism we just described. They channeled domestic savings into heavy industrial deepening, moving from copying Sheffield steel to pioneering synthetic dyes and electrical engineering. Within 2 decades, the label that was meant to protect British industry became a seal of premium quality that destroyed British market share in chemicals and machinery. The lag time between the copycat phase and the dominance phase, in the German example, was approximately 20 years. This brings us to the economic concept of the smile curve, a theory proposed by Stan Shi of Acer in the early 1990s. The curve plots the value added to a product at different stages of production. The 2 ends of the smile, high on the y-axis, represent the pre-production phase, R&D design, and the post-production phase, marketing, logistics. The bottom of the curve, the lowest point of value creation, is manufacturing and assembly. For 40 years, the developed world happily outsourced the bottom of the curve to China, keeping the high-value ends for themselves. The assumption was that the bottom of the curve is a trap. Once you are the world's factory, you lack the margins to innovate. But the mechanism of state-directed capital deepening allows a country to brute force its way up the sides of the smile. By 2018, when Chinese suppliers began displacing Japanese and Taiwanese firms in the Apple supply chain, they were no longer just tightening screws. They were manufacturing the batteries, the acoustic components, and the complex glass structures. They were moving from the low-margin bottom to the high-margin slopes. This transition is painful because it requires sacrificing current consumption for future production, a trade-off that is politically difficult in liberal democracies but features prominently in the 5-year plans of command economies. The danger for the West is not that China provides cheap goods. The danger is that the Made in China label is undergoing the same reputational flip that Made in Germany experienced in 1900 and Made in Japan experienced in 1980. The supply chain is not just moving geographically, it is moving structurally. We are witnessing a shift where the emerging power stops importing the machines to make the goods and starts making the machines themselves. This creates a specific signal in the trade data, a collapse in the import of capital goods combined with a surge in the export of intermediate components, which is exactly what we are seeing in the 2024 data. But if history teaches us that the mechanism works, it also teaches us that it eventually breaks, usually when the suppression of the household sector reaches a mathematical limit. The last time the global economy faced a shift of this magnitude, it didn't happen in Mandarin, it happened in Japanese. In 1958, Toyota exported its first passenger car, the Toyopet Crown, to the United States, a vehicle so ill-suited for American highways that it would overheat on steep inclines and vibrate violently at 60 miles per hour. It was a commercial failure that reinforced the prevailing American sentiment. Japan made cheap trinkets, paper umbrellas, and knockoff toys, but serious heavy industry was the domain of the West. Yet, just like the German example before it, the signal was hiding in the capital structure. While American automakers were optimizing for quarterly dividends, Japanese keiretsu networks, tightly knit groups of manufacturers and banks, were executing the second iteration of our mechanism map. Let's revisit that mental flowchart. Funding source, suppressed household income. Intermediary, state-directed banking. Macro outcome, industrial capital deepening. In the Japanese context of the 1970s and 80s, the Ministry of International Trade and Industry, MITI, acted as the conductor, guiding low-cost bank loans into favored sectors like consumer electronics and automobiles. This created a unique environment where companies could sustain losses for years to capture market share. A strategy known as predatory pricing by its victims and long-termism by its beneficiaries. By 1980, Japan hadn't just caught up. It had redefined the production process itself with just-in-time manufacturing. The lag between the Toyopet disaster and the dominance of the Honda Civic was roughly 22 years, strikingly similar to the timeline we are currently observing with Chinese electric vehicles. However, there is a critical deviation in the current cycle that makes the China challenge distinct from the Soviet Union, our necessary counterexample. The common assumption in Western capital cities is that state-directed economies inevitably stagnate because bureaucrats cannot allocate capital as efficiently as the market. This was true for the USSR. The Soviet system failed because it removed the price signal. Gosplan planners set quotas for steel and grain, leading to a surplus of goods nobody wanted and a shortage of everything they did. The factories continued to run, but they destroyed value rather than creating it. China has avoided this trap so far by introducing a brutal layer of internal competition, effectively crowdsourcing the selection phase of evolution to the market, while the state subsidizes the mutation phase. This leads us to the concept of the fitness center. For a multinational corporation today, operating in China is no longer about accessing cheap labor. It is about accessing the world's most aggressive gym for industrial competitiveness. The state provides the capital to flood the zone with competitors. Witness the hundreds of domestic EV makers that emerged in the last decade. and then allows domestic competition to kill off the weak. This creates a specific modification to our mechanism map. The flow is still suppressed income, state banking, but the macro outcome is now strategic overcapacity. The system deliberately funds too many companies in a hot sector, accepting that 90% will fail, because the surviving 10% will emerge as battle-hardened giants capable of crushing global competition. This is a form of state-sponsored Darwinism. When Tesla opened its gigafactory in Shanghai, it wasn't just looking for production capacity, it was stepping into the ring. The Chinese government approved the factory, the first wholly foreign-owned auto plant in its history, specifically to act as a catfish in the tank, terrifying domestic manufacturers like BYD and NIO into innovating faster. The result is a supply chain velocity that is difficult to replicate elsewhere. In Shenzhen or Dongguan, a hardware engineer can prototype a new board, source the components, and have a revised unit on their desk within 24 hours. In Silicon Valley or Munich, that same iteration cycle might take 2 weeks due to shipping and customs. This cluster effect is the new moat. Western firms that decouple from China aren't just losing a sales market, they are disconnecting from the fastest feedback loop in industrial history. They risk what we might call innovation atrophy, becoming slower and more expensive relative to the competitors forged in the Chinese gym. But this gym membership has a steep price, and the currency is data. The modern bargain for foreign firms is no longer technology for market access, as it was in the early 2000s. It is now data for speed. To survive in the Chinese ecosystem, Western firms must integrate deeply with local digital platforms and supply chains, effectively training their own future competitors. We see this in the machinery sector, where German hidden champions, the Mittelstand, are finding that their Chinese partners who used to be mere assemblers are now producing tunnel-boring machines and precision tools that match German specs at 60% of the price. This brings us to a pivotal realization about the made-in-China supply chain. It is sticky. You cannot simply lift a factory from Guangdong and drop it into Vietnam or India and expect the same output, because the factory is not an island. It is a node in a dense web of suppliers. When companies attempt China plus one strategies to diversify risk, they often find that their Vietnamese assembly plant is still importing 80% of its subcomponents from China. The label changes to Made in Vietnam, but the value-added tax revenue and the industrial ecosystem remain anchored in the original hub. The supply chain has deep roots, and tearing them up is inflationary, disruptive, and slower than political rhetoric suggests. This sets the stage for the friction we see today. The mechanism of suppressing household income to fund industrial dominance has a mathematical limit. Someone has to buy the goods. If the Chinese household share of GDP remains low, currently hovering around 40% compared to 60–70% in most developed economies, domestic consumption cannot absorb this massive industrial output. The surplus must be exported. In the past, the world absorbed these exports because they were cheap consumer goods that improved Western purchasing power. But now, the exports are high-tech automobiles, semiconductors, and machinery that directly compete with the core industries of Europe, Japan, and South Korea. The fitness center is now exporting its champions to the world stage, and they are arriving not with cheap plastic, but with advanced software and batteries. This collision is generating specific distress signals in the global financial data, flashing red warnings that the era of cooperative globalization has fractured into a zero-sum game for industrial survival. These red warnings are not abstract metaphors. They are visible in the hard data of 2024, provided you know where to look. To see the mechanism shift in real time, we must examine 3 present signals that confirm the Chinese economy has fully rotated from the real estate engine to the high-end manufacturing engine. The first signal is the Great Credit Rotation. For 2 decades, the primary destination for Chinese bank credit was the property sector. That era is mathematically over. In 2024, investment in real estate development collapsed by nearly 11% year-on-year, continuing a multi-year contraction. But the money did not disappear, it migrated. In the same period, investment in high-tech manufacturing surged by over 9%. outpacing overall investment growth by a factor of 3. If you look at the loan books of the major state banks, medium to long-term loans to the manufacturing sector are growing at roughly 15% annually, while the real estate loan book is shrinking. The state has effectively turned off the tap for apartment towers and opened the floodgates for factories. This is not a market cycle, it is a policy-engineered capital redirection of historic proportions. The second signal is the price-volume divergence, which confirms the strategic overcapacity outcome in our mechanism map. In a normal market, if demand is weak, you cut production. In the fitness center model, you maintain production to kill competitors, even if it means slashing prices. Since mid-2023, China's export prices have been in a persistent decline, yet export volumes have surged. In sectors like electric vehicles and steel, export volumes skyrocketed by roughly 75% between 2022 and 2024, while unit prices fell. This is the definition of exporting deflation. China is effectively transferring its domestic overcapacity to the rest of the world, dampening global inflation readings, while crushing the margins of foreign competitors who cannot subsidize losses with state credit. The third signal is the Japan crossover, a measurable turning point that future historians will likely mark as the end of the post-war industrial order. For nearly 5 decades, Japan was the world's undisputed king of automotive exports. In 2023, China took that crown, exporting 5.2 million vehicles compared to Japan's 4.4 million. In 2024, the gap widened further, with Chinese auto exports up another 22%. What makes this signal terrifying for Wolfsburg and Tokyo is the composition of the trade. These are not the cheap, rattling combustion engines of the past. Over 30% are electric vehicles, and a growing share are high-tech hybrids. The Made in China label has successfully climbed the smile curve, and it is now eating the lunch of the G7 economies. This brings us to the most common counterargument heard in Western financial media: China is uninvestable. Critics point to the crackdown on tech giants, the property crisis, and the exodus of hot money foreign capital as proof that the Chinese model is failing. This analysis misses the forest for the trees. The flight of speculative Western capital is real, but it acts as a cleansing fire for the fitness center. The exit of short-term tourists leaves the market to the serious long-term players, the Teslas, the BASFs, the Saudi Aramcos, who are doubling down on physical plant investment. The uninvestable narrative is a comforting story we tell ourselves to mask the reality. The Chinese system is not collapsing, it is shedding its skin. Let us each return to our mechanism map for the third and final layer. Funding source, suppressed household income. Intermediary, state-directed banking. Macro outcome, deflationary export shock. The arrow leaving the final box points directly at the industrial bases of the developed world. This is where we must apply the who pays lens. In a globalized economy, trade balances must net to zero. If China runs a manufacturing trade surplus approaching 1 trillion, roughly 2% of global GDP, someone else must run a corresponding deficit. Historically, the United States played the role of the consumer of last resort, absorbing cheap goods and printing dollars in return. The US consumer paid with a hollowed-out Rust Belt but benefited from cheap electronics. But the math has changed. The new wave of Chinese exports, EVs, machinery, ships, does not target the American consumer wallet as much as it targets the German and Japanese industrial value add. The made-in-Germany economy relies on exporting high-precision machinery to China. If China now makes that machinery itself and exports it to Germany, as traditional markets in Eastern Europe and Latin America, the German business model faces an existential crisis. The payment chain is shifting. The cost of China's rise is no longer being paid by the Ohio steelworker, but by the Bavarian engineer and the Nagoya auto parts supplier. This brings us to the final calculation in our who pays ledger. The uncomfortable reality for Western policymakers is that protectionism, the current tool of choice, is trying to solve a 20th century problem in a 21st century network. The supply chains built over the last 40 years are not Legos, they are organic ecosystems. You cannot simply snap them apart and reassemble them in Arizona or Saxony without incurring massive efficiency losses. This organic complexity leads us to our quantified if-then funnel, which provides the roadmap for the next 12 to 18 months. Base case, 65% confidence. If China's manufacturing trade surplus remains above 10% of its GDP for 2 consecutive quarters, a level currently unprecedented for an economy of its size, then we will see a structural fracture in the global trading system. The reaction function will not just be higher tariffs from the US and EU, it will be a wave of defensive industrialization from the global south. Countries like Brazil, Turkey, and India will be forced to erect barriers to prevent their own nascent industries from being drowned by Chinese deflationary exports. This leads to a world of fragmented trade blocs where efficiency is sacrificed for resilience, and global inflation creates a higher structural flaw than we have seen in decades. Alternative case, 25% confidence. If Beijing executes a massive pivot toward domestic consumption, effectively forcing wages up and subsidizing households instead of factories, then the export pressure valve releases. The made-in-China machine turns inward to satisfy its own citizens. However, this nullifying condition requires a political restructuring of the Chinese economy that shifts power away from the state-linked production complex, a move that current leadership has shown little appetite for. The nullifier. Watch the renminbi. If the currency is allowed to appreciate significantly, it would naturally rebalance this trade distortion. But as long as the mechanism prioritizes industrial market share over currency strength, the export flood will continue. This dynamic exposes the Made in India or Made in Vietnam labels for what they often are. Regulatory arbitrage. When you buy a phone assembled in Bangalore or Hanoi, you are often buying a device where the complex, high-value components, the screens, the batteries, the precision casing, were still produced in Guangdong. The final assembly has moved to avoid tariffs or lower labor costs. But the deep supply chain, the root system of the industrial tree, remains firmly planted in China. This is the sticky nature of the network. China has effectively moved upstream, becoming the supplier of the suppliers. It is no longer just the factory, it is the control tower. This evolution completes the narrative arc we began with the iPhone. The world spent 30 years building a global machine designed to optimize efficiency, assuming that commerce would democratize the participants. Instead, the machine was hacked. By using the smile curve, not as a trap, but as a ladder, China utilized financial repression to fund a state-of-the-art industrial base that now sits at the technological frontier. Let's lock in the mechanism map one final time to ensure retention. The process begins with suppressed household income, stripping purchasing power from the consumer. It flows into state-directed banking, which ignores short-term profit for strategic goals. It terminates in global industrial displacement, where the surplus capacity is exported to the world, forcing foreign competitors to either subsidize their own industries or face extinction. The era of Made in China, meaning cheap and low quality, is a relic of history, as dead as the era of Made in Germany, meaning British knockoff. The label now represents a challenge to the commanding heights of the global economy. For the investor and the observer, the signal to watch is no longer the price of labor in Shenzhen. It is the volume of high-tech exports leaving Shanghai. The trade war was never about soybeans. It was always about who controls the machinery of the future. But if trade balances are the symptom, currency is the ultimate scoreboard. As this surplus grows, the pressure on the global monetary system is building toward a breaking point. How long can the world absorb these exports before the currency markets force a realignment? That leads us directly into the dark mechanics of competitive devaluation and the looming specter of a currency war, which is exactly where we will pick up in the next dossier.